Billionaire's warning: the crash is already here. Podcast: The Diary of a CEO with Stephen Bartlett. Guest: Jeremy Grantham, co-founder, GMO, long-term investment strategist. Source: YouTube/Spotify, The Diary of a CEO. Date: June 25, 2026. Part 1. Who is Jeremy Grantham? Jeremy Grantham is not a household name in the way that celebrity investors sometimes are, yet his track record places him among the most consequential financial minds of the past half-century. He co-founded the institutional investment firm GMO in Boston in 1977, and over the following decades he steered portfolios that at their peak reached $165 billion in assets under management. He did not build that record by chasing the crowd. His signature was patience and an almost obsessive focus on the long term, a willingness to look past the noise of any given quarter and ask what a market, an economy, or even a civilization is actually doing over years and decades. Grantham is also one of the few figures who helped pioneer the very tools that define modern investing. Early in his career, alongside a handful of peers who were thinking independently, he contributed to the popularization of value investing, small-cap investing, and indexing, the idea that passive, diversified exposure to an entire market can outperform most active stock pickers over time. He has spent roughly 60 years managing other people's money, and when the smoke cleared over his own finances, he had earned well over $1 billion personally. He is 87 years old. He has given away more than 90% of that billion, perhaps closer to 95%, to the Grantham Foundation for the Protection of the Environment, which he chairs and which invests heavily in green technology to combat climate change. He introduces himself not as a billionaire, but as someone who specializes in a longer-term horizon than most people and who tries to look at a higher level of abstraction, to ask what is really going on and what people are missing. He has discovered, over 6 decades, that humans are extraordinarily short-term in their thinking and almost hardwired toward optimism. That conviction shapes everything he says. Part 2. The AI Bubble, the biggest in American history. Grantham is unequivocal about artificial intelligence. He regards it as one of the defining technological ideas of the last 200 years, up there with the railroads and the internet in terms of the transformation it will bring to civilization. He believes it will change everything. That is precisely why he is worried. Because the greatest investment bubbles in history have not formed around scams or frauds. They have formed around the most genuinely important ideas of their age. The railroads, in the mid-19th century, really did change the world. They compressed geography, moved goods and people at previously unimaginable speed, and reshaped entire economies. Every investor could see this. Everyone wanted in. Capital flooded the sector, valuations soared far beyond what the underlying earnings could justify. And when the bubble broke, railroad stocks collapsed and investors lost fortunes, even though the technology itself was every bit as transformative as advertised. The internet followed the exact same script a century and a half later. Amazon, one of the clearest eventual winners of the digital age, fell 92% from its peak during the dot-com crash of 2000 to 2002. 92%. And then, out of the wreckage, it went on to inherit the retail world. AI, Grantham argues, is following the same arc. The greater the idea, the more obvious its potential, the more money floods in, the bigger the bubble, and the bigger the inevitable bust. He believes the current AI-driven mania in U.S. markets represents the biggest investment bubble in American history. The valuation levels he is observing are, in his assessment, higher than those seen at the peak of the tech bubble in 2000, which itself resulted in the Nasdaq, the index of growth stocks, falling 82%. As a signal of the euphoria he sees, Grantham points to SpaceX. The company has publicly defined its addressable market as a quarter of global GDP. It speaks of mining asteroids and colonizing other planets across 50 and 100-year horizons. Grantham draws a direct parallel to the South Sea bubble of the 18th century, where the prospectus famously described an enterprise of such enormous value that its nature could not at that time be revealed. He predicts that in 100 years, people will tell cautionary stories about SpaceX and its fundraising documents the way financial historians now tell stories about the South Sea Company. Part 3. How Bubbles Work, Patterns from History. A bubble, at its most basic, is the collective result of too many people believing in an idea at the same time and channeling money into it faster than the underlying economics can support. Everyone sees the potential. Everyone piles in. Prices rise. Rising prices attract more investors, who push prices higher still, until the gap between what assets are priced at and what they are actually worth becomes so extreme that the structure collapses under its own weight. Grantham uses a simple but powerful metric to gauge where markets stand: the price-to-earnings ratio, or P/E, which tells you how much money investors are paying for every dollar of corporate earnings. In normal, healthy markets, that ratio tends to sit somewhere around 15 to 17 times earnings. At the height of the tech bubble in the year 2000, the U.S. market was trading at 31 times earnings. The biggest bubble in modern financial history was Japan in 1989, when the Japanese market reached 65 times earnings. Japan at that moment seemed to rule the global economy. Its technology was dominant. Its cars were outcompeting Detroit. Its consumer electronics were everywhere. For a brief period, the Japanese stock market was valued at more than the entire U.S. market. Then it collapsed. The Japanese market fell for 20 years. What is commonly called the lost decade is, when examined closely, closer to a lost 20 or even 30 years. It took 35 years for the Japanese market to fully recover. The U.S. market today, Grantham believes, is trading at levels comparable to or higher than the peak of 2000, and he believes it is arguably the highest it has ever been in American history. Based on historical patterns, he considers a decline of 70% in the most inflated AI-driven stocks to be entirely possible, and not even historically extreme given analogous precedents. Part 4. What happens when the bubble bursts? When asset bubbles break, the damage does not stay contained to the portfolios of wealthy investors. It spreads through the entire economy. Companies whose stocks have soared lay off workers. People who have accumulated savings in the market feel poorer and spend less. Consumer spending contracts. The economy moves under stress. Grantham notes that historically, when people accumulate wealth in rising markets, they spend a fraction of it, perhaps 2 or 3%, in their daily lives. When that wealth evaporates, they pull back by a similar fraction. It seems modest in percentage terms, but multiplied across millions of households, it translates into a meaningful drag on growth. The historical record is sobering. The crash of 1929 was followed by the Great Depression. The Nifty 50 bubble of 1972, named for the 50 great companies like IBM and Coca-Cola that investors believed could never fail, declined 65% in real terms when it broke, and the recession that followed was the worst since the Depression. The tech bubble of 2000 produced a decade of lost returns in U.S. equities. Anyone who invested in the S&P 500 in January 2000 had less money in real terms 10 years later than when they started. The collapse Grantham anticipates from today's levels could produce a similar or worse outcome, given that current valuations are, in his view, even more stretched than they were in 2000. Part 5. Investment Strategy. What to do now? Grantham's prescription for the average person begins with a principle that sounds simple but is routinely ignored: diversify. Do not concentrate your financial future in any single asset class, and certainly not in the most inflated one. He recommends building a portfolio that spreads exposure across bonds, cash, a small allocation to precious metals such as gold and silver, and, if one must hold equities, stocks and markets outside the United States. On bonds. A bond is essentially a loan to a government or corporation that pays a fixed rate of interest for a defined period. The U.S. government issues bonds at maturities ranging from 90-day Treasury bills to 30-year-long bonds. At current rates, a 10-year U.S. Treasury bond yields roughly 4.5% per year. A 10-year corporate bond from a company like Apple yields approximately 4.7%. These are not exciting returns, but they are stable and predictable. And in an environment where stock prices could fall dramatically, a guaranteed 4 to 5% per year in fixed income becomes very attractive by comparison. Grantham has noted that there have been periods in history, such as 1974, when bonds yielded 8, 9, or even 10%. On equities, Grantham's single clearest piece of advice for anyone who must hold stocks is to hold them outside America. Non-U.S. markets, European equities, Japanese stocks, Canadian and Australian markets, and emerging market indexes, are significantly cheaper on virtually any valuation measure than U.S. equities. Since the beginning of 2025, these international markets have meaningfully outperformed the U.S. Grantham is confident that most of these markets will muddle through reasonably well over the next 10 to 20 years. He is not confident the same can be said of the U.S. market in anything like its current form. He recommends broad international index funds, sometimes described as World ex-US funds, as a practical and accessible way to gain this exposure. His suggested portfolio breakdown, distilled from the conversation, is approximately 60% in non-US equity indexes, up to 10% in precious metals, and the remainder in bonds yielding 4.5% to 5%, with zero allocation to U.S. equities and zero allocation to cryptocurrency. Part 6. The housing market. Property represents its own dimension of the financial crisis Grantham describes. House prices across the developed world have been engineered, through low interest rates, restrictive zoning, and favorable tax treatment, to rise steadily for 3 decades. This is a good outcome for those who already own homes, and a deeply damaging one for those trying to enter the market. In the United Kingdom in 1994, the average home sold for roughly 3.5 times annual family income. That was about as affordable as housing had been in half a century. By the mid-2020s, depending on location, that ratio had climbed to over 10 times income. A reasonable young couple earning average wages today cannot realistically buy a home. The same high prices feed directly into rents, compressing the finances of younger generations from both sides. The pattern is global. Canada, Australia, China, and most of Europe have experienced similar dynamics. Even if house prices were to fall 30% from current levels, a decline Grantham considers plausible, they would still sit at 6 or 7 times family income. That would be twice the level that prevailed during what he describes as the good old days of affordable housing. The correction, in other words, would still leave housing expensive by any long-term historical standard. Part 7. Why Wall Street Will Never Warn You. One of the most striking sections of the conversation concerns the systematic failure of the financial advisory industry to tell clients the truth in moments of market excess. Grantham explains with complete directness. From 1929 to the present day, no major investment firm, no Goldman Sachs, no Morgan Stanley, no J.P. Morgan, has ever told its clients to get out of the market because it is overpriced. Not once. Not during the crash of 1929. Not during the Nifty 50 collapse of 1972. Not during the tech bubble of 2000. The reason is simple economics. It is terrible for business. If an investment firm warns its clients that markets are dangerously overvalued and clients respond by withdrawing their money, the firm stops collecting the management fees that are its entire revenue stream. The incentive structure points in only one direction: optimism. And because timing a bubble is genuinely uncertain, even advisors who privately believe a crash is coming cannot afford to say so. The market might continue rising for another 2 years. Clients who follow cautious advice and miss those gains will fire their advisor long before the crash they were warned about actually arrives. Grantham recounts a striking episode from 1998 and 1999 at the peak of the tech bubble run-up. At a conference of 1,200 investment professionals, the annual gathering of the Society of Analysts, he surveyed 400 self-identified full-time stock market experts from the floor. He asked them 2 questions. First, if the market, then trading at 31 times earnings, were to return to a more normal 17 times earnings, would that guarantee a major bear market? All 400 said yes, without hesitation. Second, did they think that reversion would happen? More than 99% said they believed it would. In other words, nearly every professional in that room privately believed a crash was coming. And yet the partners and managing directors of the same firms were on stage with Grantham at that very moment, calmly reassuring the public that things would muddle through nicely. The crash, of course, came. Grantham calls this a massive betrayal of trust. He believes the same dynamic is playing out today. GMO itself paid a significant price for intellectual honesty. When Grantham began warning about the tech bubble in 1998, he was 2.25 years early. In that time, his firm lost half its client base. People saw the market continuing to rise and concluded that he was simply wrong. The moment of vindication, when the crash finally arrived, came too late for the clients who had already left. Part 8. Advice for founders and entrepreneurs. For founders and entrepreneurs whose companies depend on investor capital, Grantham's advice takes on a particular urgency. The sun is shining right now in the startup and venture capital ecosystem. Money is flowing, valuations are elevated, and early-stage companies, particularly those with an AI angle, can raise capital on optimistic terms. Grantham's message is direct: do not assume this will last. Raise as much money as you can while it remains available, because when the market turns, capital can disappear with extraordinary speed. In bubble burst environments, even well-run companies with genuine products and real revenue can find themselves unable to raise. Investors who were enthusiastic in the euphoria become deeply risk-averse in the downturn. Companies that have locked up large cash reserves going into the contraction will survive and, as Grantham notes with approval, may be in a position to act as acquirers, picking up distressed competitors and assets at a fraction of their peak valuations. Companies that have not prepared will simply go out of business. His broader principle for business owners is to build in conservatism now, extend runways, reduce burn rates where possible, and treat the current moment not as a period of abundance to be fully spent, but as a window in which to accumulate the reserves that will carry you through a harder period that may arrive without much warning. Part 9. AI's Real Risks: Jobs, Power, and Alignment. Beyond the financial bubble, Grantham engages with the deeper social risks that artificial intelligence creates. He acknowledges that AI will reshape the labor market in ways that are difficult to fully anticipate, but he views the disruption as likely to be severe for a wide range of professions. The technology does not threaten only routine, repetitive work. It threatens knowledge work, the kind of analytical, diagnostic, and creative tasks that have historically justified higher wages and offered a path to middle-class stability. More troubling for Grantham is the question of power concentration. Artificial intelligence, in its current trajectory, is likely to be a powerful tailwind for the largest and most established technology companies, the so-called Magnificent Seven that already dominate market valuations and, through their platforms, enormous portions of daily economic and social life. Monopoly power, Grantham notes, has a paradoxical effect on economies. It raises the profit margins of the dominant firms while simultaneously slowing overall GDP growth, because the gains are captured by shareholders rather than distributed through wages and competition. He also raises the question of alignment, whether advanced AI systems will behave in ways that serve human interests, framing it as an open and serious question rather than a settled one. He does not claim certainty about the outcome, but treats it as one of several systemic risks that receive far too little serious attention relative to the short-term excitement around AI-driven stock returns. Part 10. Bitcoin, Crypto, and the Cult of Hype. Grantham's position on cryptocurrency is among his most categorical. He describes it as an unnecessary piece of nonsense that facilitates nothing except the movement of money by criminals who do not want to be seen. He believes Bitcoin will ultimately go to zero. This is not a hedged prediction. He states it as a straightforward conclusion drawn from his analysis of what the asset actually is and what underlying economic value it represents. His dismissal of crypto is consistent with his broader framework for identifying bubbles. When an asset rises primarily because other investors believe it will keep rising, rather than because it produces earnings, dividends, or any underlying economic value, it is in a bubble regardless of the narrative surrounding it. The AI narrative around crypto, blockchain as the infrastructure of a decentralized financial future, does not move him. He views the technology as a solution searching for a problem that conventional financial infrastructure already solves more efficiently. Part 11. Wealth inequality and the broken social contract. Grantham identifies wealth inequality as the most significant long-term economic problem confronting the United States, more fundamental, in his view, than even the market bubble, because it is the condition that makes democratic political solutions to the bubble so difficult to achieve. The numbers are stark. The richest 1% of Americans now control 31% of the nation's total wealth. The bottom 50% share just 2.5%. The richest 10 U.S. billionaires saw their wealth grow by 526% in real terms between 2020 and 2025. Between 1989 and the mid-2020s, The financial gain of a household at the top 1% threshold was 987 times larger than the gain of a household in the bottom 20%. He places this in historical context. From 1935 to 1975, a 40-year span covering the Roosevelt era through the early 1970s, the United States experienced a golden period of broadly shared growth. Real economic gains exceeded 3.5% per year. The poorest quarter of households gained slightly faster than average. The richest quarter gained slightly slower. Everyone got richer. The political and social stability of that era was, Grantham argues, a direct consequence of this broadly shared prosperity. Since 1975, the average inflation-adjusted hourly wage in the United States has barely moved. All of the wealth generated since then has flowed primarily to the top 10% of earners, and a disproportionate share of even that to the top 100th of 1%. The United States now has a Gini coefficient, the standard international measure of income inequality, that places it alongside Brazil and Mexico, countries Americans have historically regarded as far less equal than their own. What history tells us happens next when inequality reaches these extremes is, in Grantham's assessment, nothing good. War, revolution, economic collapse, or some combination of all three. He points to one metric he finds particularly telling: maternal mortality rates. The United States is one of the wealthiest countries in the world, yet its rate of deaths among women during or shortly after childbirth is 50% higher than the next worst comparable developed nation. For Grantham, this single number is the clearest indictment of a society that has allowed its social contract to erode. What better definition of civilization, he asks, than how a country looks after the mothers giving birth? By that standard, the United States is failing. Part 12. The Fertility and Toxicity Crisis. Perhaps the most alarming section of the conversation concerns a crisis that Grantham argues is simultaneously the most important and the most systematically ignored: the collapse of human fertility, which he believes is being driven in significant part by the proliferation of synthetic chemicals in the modern environment. Sperm counts globally have fallen from approximately 100 million per milliliter in 1970 to roughly 35 million per milliliter today, a decline of more than 65% in under 60 years. The rate of decline is approximately 2.5% per year and appears to be accelerating. The threshold above which conception is considered easy is approximately 45 million per milliliter, a level that average sperm counts crossed roughly 15 to 20 years ago. The World Health Organization currently estimates that 17% of couples require medical assistance to conceive, up from near zero a few decades earlier. At the current rate of decline, Grantham notes, the median male may reach functional infertility by around 2045. The driving mechanism, based on research by epidemiologists including Shauna Swan, is what scientists call endocrine-disrupting chemicals, compounds that interfere with the hormonal systems that regulate reproduction. These include phthalates found in cosmetics, shampoos, and food packaging, BPA and related compounds in plastics, PFAS compounds in nonstick cookware and water-resistant coatings, and pesticide residues on food. These substances are not incidental contaminants. They are pervasive, present in essentially every body on Earth, and measurable in human brain tissue. Grantham cites two small but striking studies conducted at Harvard and Massachusetts General Hospital. In the first, approximately 800 men at a fertility clinic self-reported their pesticide exposure through fruit and vegetable consumption over a 6-month window. At the end of the period, the sperm count of the quarter who ate the most pesticide-contaminated produce was half that of the quarter who ate the least. None of the participants had fully normal sperm counts by the end of the study. The implications of a simple dietary change, switching to organic produce, appeared to have measurable reproductive consequences. Plastics compound the problem in a second way. The microplastic particles that have accumulated in human tissues are themselves leaching additional toxins. The regulatory response has been, by Grantham's account, grotesquely inadequate, particularly in the United States. In the cosmetics industry alone, there are approximately 10,000 chemicals in common use. The European Union has banned 1,500 of the most dangerous. Canada has banned roughly 550. The United States has banned 12. The fertility crisis connects directly to the population dynamics he describes. Japan saw its annual births fall from 2.5 million in 1948 to under 700,000 today, a collapse Grantham describes as not theoretical. The same trend is unfolding at different speeds across the developed and developing world. South Korea, he suggests, has already passed a demographic point of no return. He believes the world's population is headed for a significant long-term decline, not in 200 years, but within the lifetimes of people alive today. Part 13, Climate Change, the Slow-Moving Catastrophe. Climate change is the thread that initially drew Grantham into thinking about environmental risk 27 years ago when he established his foundation. What began as a commitment to environmental causes led him into the overlapping crises of insect decline, chemical toxicity, and fertility, problems he traces back to the same underlying dynamic. A form of capitalism that externalizes its costs onto nature and human health while defending its right to do so through legal and political pressure. Insects have declined in flying biomass by 50 to 75%, a collapse with cascading consequences for pollination, food chains, and ecosystem stability. Climate change, if unaddressed, will make large portions of the planet increasingly uninhabitable. For the first time in 2024 and 2025, the global cost of preventing and repairing climate-related disasters reached approximately 0.5% of global GDP. Grantham expects that figure to grow steadily and significantly. He notes that awareness of climate change as a serious issue now spans virtually the entire world, with one notable exception. On the question of whether civilization can rise to the challenge, Grantham is guardedly hopeful. He believes a carbon-neutral global economy is technically achievable within this century if sufficient political will exists. The obstacle is not science or engineering. It is the political power of vested interests in fossil fuels and industrial chemicals, interests that have, in his view, successfully delayed and diluted action for decades. The United States, under its current political direction, has effectively removed itself from the global coalition addressing this challenge, a development Grantham regards as a serious and self-inflicted wound. Part 14, Where to Live, Social Trust and Civilization. The conversation concludes with a question that Grantham declines to answer too directly, whether his own children should consider leaving the United States. But his implication is clear. He describes a social contract as an agreement that one will behave in ways that help one's neighbors. By that standard, he argues, the United States has been failing for several decades, and the failure is accelerating. The countries he points to as models are the Scandinavian nations, Denmark, Norway, Sweden, along with others that have maintained strong social safety nets, universal healthcare, and broadly shared prosperity. These societies have not maximized the incomes of their top earners to the same degree as the United States, but they have maintained the conditions under which ordinary families can afford housing, access healthcare, educate their children, and live without the constant precarity that defines life for a significant portion of the American population. His parting observation is about the nature of the crises he has described: the financial bubble, the housing unaffordability, the toxic chemical crisis, the fertility collapse, the weakening of the social contract. All of these, he argues, share a common root: a form of short-term, profit-driven thinking that systematically discounts the future. Economists believe in perpetual compound growth on a finite planet. Investors believe markets can only go up. Chemical companies defend their right to produce toxins. Fossil fuel interests block climate action. Each is making a rational short-term calculation at the cost of the long-term systems that make those calculations possible in the first place. Jeremy Grantham, at 87, having spent 6 decades studying these patterns and giving away nearly everything he earned, is trying to say something very simple. The bill is coming due. Billionaire's warning: the crash is already here. Podcast, The Diary of a CEO with Stephen Bartlett. Guest, Jeremy Grantham, co-founder, GMO, long-term investment strategist. Source,